today. Joining us now, Morgan Stanley's Jim Karen, PIMCO's Aaron Brown, and Jim Bianco of Bianco Research. Jim, I want to come to you. How the events unfolding before us in Europe, in Ukraine, and this relationship that Russia has with the rest of the world, I'm not sure we can call it that anymore because there's not much of one, bar China. Jim, how does this set the stage for a Federal Reserve that somehow has got to make a forecast about what the future looks like in the US economy and for the world too?
Oh, it's going to be extraordinarily difficult for the Fed to try and figure out what they're going to go next. But the overriding thing that the Fed is going to focus on, I think, is going to be inflation. They've made it very clear that that is their priority right now. A growth, financial stability might have to take a back seat to it. And I think that the Fed is going to probably make the case that they're going to raise rates and continue to raise rates until inflation moderates. And if the economy has to stumble, as Chairman Powell said in testimony 2 weeks ago, history will show that they're ready to potentially put the economy into recession. I don't think a lot of investors are ready for that or want to hear that, but I think they've made that very clear.
Look at this banner, Jim Karen, that we're running right now. And I'm not criticizing the team at all whatsoever. This is a summary of the way markets are priced this morning and what people are saying about markets. This idea that talks between Ukraine and Russia are going well, try and reconcile that with the words of the Ukrainian president in the last 10 minutes, Jim.
Yeah, there's clearly a disconnect. I mean, what's happening on the ground in the Ukraine, as we've seen just now, is a complete tragedy. The markets are focused on, though, any marginal differences that they can really just hang on to. So in a bad situation, if things are getting marginally better, that shows that the delta is starting to change effectively towards, hopefully towards a brighter future. And that maybe this kind of a speech, this kind of a plea, maybe the upside in the futures markets and in the markets are maybe suggesting that, Russia's hearing this loud and clear, and they're realizing potentially that, the world is really against them on this stage. When we think about the Fed, though, I think that we have to understand their policy reaction function, and their policy reaction function is very clear. And it's basically that they need to keep inflation expectations anchored. So while this event is taking place, this tragic event, it is also creating a supply shock in the markets that's creating higher energy prices and higher inflation. And they need to address that, again, to keep inflation expectations anchored. And I can't stress that enough. So that's where I think the Fed's mind is right now.
Jim Karen, Jim Bianco with us through the opening bell. Aaron Brown of PIMCO with us too. Going into that, futures are elevated, up by 1.28% on the NASDAQ. On the S&P, up about 1%. If you get to the bond market, yield shaping up as follows on a 10-year yield going into the Federal Reserve decision a little bit later. 216 yields up a couple of basis points. Euro-dollar firmer, approaching 110 through that level earlier, back down to 109.91. That currency pair up a third of 1%. And crude all over the place, 98.20 on WTI, up 1.8%. Somehow this Fed's going to make a decision today. We imagine they're going to be raising interest rates. From there, it's pretty simple, isn't it, Mike McKee? From there, you lift your forecast for inflation, drop your forecast for growth, and somehow tell me where the dot plot's going to be and where rates will be this year, next year, and the year after that.
Very simple, at least for the very short term, from maybe 2 o'clock to about 2:30 this afternoon. 25 basis point rate increase in the cards. That's going to happen. Then we get the new summary of economic projections and the new dot plot, and those are going to be very important, informing market expectations for what the Fed is going to do ahead. Now, the question is, what are they going to do ahead? And you look at the dot plot, and we've shown this before, you see that the market priced in less in tightening after the December meeting. They're pricing in a lot more now ahead of this March meeting. How far does the Fed go in that direction? That's going to be the kind of key question for people today. But can Jay Powell answer that? That's going to be the question for him at the news conference at 2:30. Can he tell us what Jim Karen was referring to, their real reaction function? I mean, what's going to make them move? How do they incorporate the war and what it may or may not do? And can they pull all this off? You go back to history and you look at the Fed trying to tighten, and almost every time we end up in recession. Larry Summers made the case in the Washington Post today that what you're going to get is higher unemployment. That always happens when the Fed goes into a tightening cycle, except for that one in 1994. Every other time. So the Fed is going to put people out of work. How far do they have to go as far as recession to bring inflation down?
Mike McKee, thank you. Aaron Brown, you get that one. Typically, over the last 10 years, the more we price in for the Fed, the less they're able to do. Spreads are wider, equities are lower, they back away. Is this time different?
No, I don't think this time is different. I do think, though, that the rate hiking cycle is complicated by inflation that we haven't seen, certainly in recent history. And so the Fed is trying to really walk that fine line by not tipping the economy over into a recession, but at the same time keeping inflation contained and bringing inflation down from very high levels. I think what's important to watch today are two things. One is, what is that terminal rate that the Fed is projecting? How much higher is that terminal rate relative to neutral rates? Remember, the Fed has said that neutral rates is at about 2.5%. So whether or not they really bring that terminal rate meaningfully above 2.5% is something that the market's going to be really focused on. The other thing to watch for market practitioners is what happens to the yield curve. Right now, we're going into the meeting at about 30 basis points. How that yield curve trades in 2s, 10s is going to be very important as a recessionary indicator for the market. And so as we start to see that move lower, close to zero and through zero, and eventually invert, that's going to be the key that the market's focused on, because typically 1 to 3 years after curve inversion is when the Fed rolls over into a recession.
Two pieces to that comment. Let's pick up on the first one, where the dot's head. Jim, I'm going to come to you on that and pick out, let's say, the 24 dot. The 24 dot right now is at 2.1%. Jim Karen, I caught up with Bill Dudley, the former New York Fed president, some weeks ago about this dot plot. He said they're in fancy land. How far north does that dot need to go?
Yeah, I think it needs to go considerably higher. I think that the dots are going to start to show that that the Fed is probably likely to get up to that 2.5% terminal rate, and the market expectations are, much of the consensus of forecasters are expecting that the terminal Fed funds rate is between 2.5 and 2.75%. There's a big disconnect because the market is actually pricing that it's just over 2%. So essentially, I think there's going to be an upgrade in their inflation forecast for core PCE and for headline PCE. Headline PCE running somewhere around 2.6% from the last summary of economic projections. It's probably going to be boosted up to about 4 to 5%. And core PCE is going to be boosted up to probably 3% or slightly above for the end of 2022. Now, this is interesting because these numbers are above their stated target of inflation, say 2 to 2.5%. So the whole key here is that if we're going to be above target, shouldn't the Fed do more to bring inflation back down to target? And if they don't do more, then what they're basically telling us is that they're going to allow the economy to still run hot and let these inflation pressures build for a while longer. Again, because I think it's temporary and it's driven by a supply shock. Within the forecast, will we see an implied restrictive Fed? Jim Bianco, you sent me a message earlier this week. I read them all. You said, remember that exchange with Senator Richard Shelby. Are you prepared to do what it takes to get inflation under control? Powell said, I hope history will record that answer to your question is yes. Jim Bianco, are we really going to see anything close to Volcker today?
I don't know if we're going to see it today, but I think that the Fed is going to be on that path. I do believe that there's been a rethink at the Fed and that their priority, as I said before, is inflation, and they're not going to shy away from being aggressive in dealing with higher prices, especially when it comes to the political aspects of higher prices moving higher. The March CPI number is going to be another blowout number on the upside because of the rise in gasoline prices for the month alone, not to mention agricultural prices as well, too. But over time, I think they're going to, Powell will go back to what he said in December when he was asked about raising rates aggressively, and he pointed out in the JOLTS report, there's 4.5 million more jobs available than there are unemployed. That implies he can get really aggressive without worrying about creating that unemployment that Larry Summers fretted about today. That's, in their mind, that's a ways off, and they could really start going because I do believe it's all about inflation and growth takes a back seat.
6 minutes into the session, ahead of this decision, the equity market advance is up more than 1% on the S&P and the Nasdaq up 1.6, with your movers around the open Here's Abby.
Well, John, we are having this second day of a rebound rally. The S&P 500 gained 3% over the last 2 days, the best 2 days in 3 weeks, and it's a broad-based rally. One of the top stocks for the S&P 500 is Apple, up also for a second day as buy the dippers come out, even with rates higher. And of course, rates higher, that's helping out the banks. JP Morgan up 1.9%. And of course, we have that monster rally in China. The Hang Seng up more than 9%. Its best day since 2008. Las Vegas Sands, the casino operator, more than 70% of their operation, their revenue comes from Macau. That stock up 8%. But take a look at Alibaba, some of these other tech ADRs. Those are the real winners in the tech rally. Alibaba this morning up 15.44%. Of course, after that more than 70% drop. But the question is that a real buy the dip for the long-term rebound, John? We'll find out.
Abby, thank you. Earlier on this morning, literally 30 minutes ago, we had an emotional plea from Ukraine's leader for more help on the military front. Interfax reporting the following just moments ago. Russia asking the US to stop weapons supply to Ukraine in a call. That coming from Interfax, that Russia asked US to stop weapons supply to Ukraine in a call, and that line comes just moments after we heard from Ukraine's leader. Vladimir Putin, according to TASS, saying the following: Ukraine operation successful and in line with plans. Still calling it an operation, the rest of the world calling it an invasion. Ukraine operation successful and in line with plans. The word from the Russian president just moments ago. Big move in this equity market through much of this week. At one point, the Nasdaq 100 closed in a bear market. And then we had a big bounce back. With that bounce, here's Kaylee.
Drama, John. It's nothing new for this year, but it really has been quite a turnaround for technology in particular. Granted, the gains of yesterday only go so far to help recover the losses that the Nasdaq 100 has seen this year. It's still off 16% on a year-to-date basis, as we've seen this really dramatic rotation out of technology and growth names into value. But that was not the case yesterday. It wasn't just the Nasdaq that was moving. The S&P Growth Index actually had its best day relative to its value counterpart. The third time we've seen it moving by a margin of 1.5% of outperformance in the last 3 weeks, though obviously, as we can see on this chart, that hasn't been consistent throughout the year. Another point I would make about yesterday, the only sector that actually ended the day in negative territory was energy. Of course, a classic value play, down because oil was down and down hard. WTI back below $100 a barrel, more than 20% off of its recent peak, north of 120 just on March 8th. So yes, in a technical bear market in the span of just about a week, even though it's still up some 30% on the year. And since that March 8th peak, we have seen some big losses for energy companies as well. The biggest losers since then, Schlumberger and Exxon, each down some 12%, and other big North American shale players like Marathon, Coterra, Devon, and Diamondback, all among the big laggards as well, John.
Kaylee, thank you. This bounce in tech continues at 1.7% on information technology in the early part of this session, at 1.4% on the S&P. Aaron Brown, any reason to believe that's the direction of this equity market you should be leaning?
Right now, I think that the outlook is pretty unclear for equities, and I think that while the market's pricing in about 40% equity, sort of recession risk going into the end of 2022, it's still pretty early, and I think that the outlook is going to remain pretty volatile. That said, I think there's been some really high-quality companies that have been, trading and hit pretty hard as a result of the conflict and, the risk of recession moving higher. And I think that it is time to start dipping your toe into certain sectors of the economy that have sold off, and will continue to do well, I think, because of the quality. But I do think that overall for the market, until we get more clarity with regards to the conflict and more certainty about the outlook for the U.S. economy, I do think that the environment is going to remain exceptionally choppy. That said, again, I think looking for quality within portfolios makes a lot of sense right now. And there are some really good high free cash flow generating companies that have been, trading down in excess of 10% that offer real value here.
A ton of news this morning, so I appreciate the patience of all three of you as we work through some of this. Jim Bianco, the final word goes to you, sir. This line here, the LME says electronic trading and nickel to reopen at 2 p.m. Jim, I know you've got things to say about this. Here's your opportunity.
Yeah, it's unfortunate what's happening with the LME, and that the way that they've been changing their rules and bending their rules for the benefit of a few at the expense of many. And it's a broader problem in the commodity markets right now, that quite frankly, they're pretty dysfunctional in the way that they're trading. And that's what you're seeing, in the headline one with crude oil as well, too. I hope that over the next couple of weeks, or months, we're going to start to see some normality return to those markets, and maybe some confidence that when you do a trade in those markets, that trade stands and that they won't come back and cancel it because it is inconvenient for other players that we had prices at levels that they didn't want.
Jim Bianco of Bianco Research, Jim Caron of Morgan Stanley, Aaron Brown of PIMCO. To the three of you, thank you. We heard from Zelensky.